I think the most important thing with that question is, instead of looking at an individual name, is just to look at the convertible market over time. And the convertible market has been in inception for decades now. And if you look at the long-term risk-return profile of the convertible market, you get equity-like returns with less volatility. And if you think about, in the simplest form again, what a convertible bond is, it's really those two components: that fixed income component that has the coupon, a stated maturity, and getting your principal back at maturity, plus that equity component, or that option, that right to convert into a common stock. If a stock trends lower and lower and lower, then that option, that right to convert, isn't worth very much. And the security behaves much more like a fixed income instrument, having dampened volatility. So again, if you get in a situation where you have an underlying equity that moves lower, and in some cases significantly lower, we would expect at some point that convertible bond may trade much more like a fixed income instrument. Likewise, if the underlying equity goes up, and it goes up a lot, the convertible bond will start appreciating at a level maybe not as much initially as the underlying equity moves higher, but that participation rate should accelerate the more and more the equity moves higher. So again, you have that asymmetric risk-return balance where, as the underlying equity moves higher, the convertible bond should move and accelerate higher with that underlying equity movement. And likewise, if you have a common stock that moves lower, the convertible bond should move lower at a slower rate than the underlying equity. And if you look at the history of the returns of the convertible market, that's exactly what you see from a long-term perspective.
Allianz Global Investors.